Welcome to the latest in a series of conversations with Witan's investment managers. My name is James Hart. I'm Investment Director of Witan Investment Trust, and today I'm joined by Mark Baribeau. Mark is Managing Director and Head of Global Equities at Jennison Associates. Jennison was appointed to manage the global equity portfolio on behalf of Witan in 2020. Welcome, Mark.
Thank you, James. It's great to be here.
Could you start by introducing yourself and telling us a little bit about Jennison and how the team think about approaching the challenge of investing in global equity markets?
Sure. Well, Jennison's been doing growth equity investing for over 50 years, so it's a very big platform in that regard. And the global product, which is in Witan's portfolio, is entering its 19th year, which we're very excited about. Together with my co-PMs, Tom Davis and Rebecca Irwin, we just look for market-leading companies globally that have developed a very unique business model. That's what's enabling their success in the marketplace. They've also developed very strong competitive advantages where they can defend that really nice growing profits pool that they're attacking. These are companies benefiting from very strong secular growth versus cyclical. They're usually the companies that are driving structural change in their industry. And we like to invest in a very unconstrained way around the world. So let's just take advantage of those best opportunities we find both in developed markets, emerging markets, and build a balanced approach in the portfolio that way.
Clearly, 2022 was a year where growth equities in particular, and indeed equities in general, it was a challenging year for investors. Why was it so tough for growth investors? And as we enter 2023, can you see some light at the end of the tunnel for equities in general, and particularly for more highly rated growth equities?
Yeah, 2022 was tough. I mean, we haven't gone through a year like that since 2001. So there were two main factors. Number one, the speed at which interest rates rose, both at the short and long end of the curve, beginning really in November of 2021, throughout most of the year, led to extreme multiple or valuation compression. On average for growth companies, it was well over 30% decline in valuation. So that's easy to dissect and put aside. But the second issue that affected growth companies in particular was the market perception or fear that there was a lot of demand pull forward for products and services in the technology arena, in e-commerce and other applications during the pandemic. And as the pandemic eased and the world economies opened up one by one, you saw a resumption of normal activity. There was real concern in the marketplace that what we saw during the pandemic couldn't be repeated, and maybe too much demand was pulled forward for these great companies, and that also depressed valuation. Now, as we walk into 2023, we see a very different environment. There's a lot more clarity on the demand front across the board, and there's renewed interest in companies that are at the leading edge of very innovative trends. So far, so good in the beginning of 2023. It is a much healthier or more neutral backdrop for equities than we saw last year.
So, I mean, as an active manager yourself, you didn't have to just sit there and take it on the chin, did you? You were able to respond to a changing environment as it changed quite dramatically through the course of the year with, as you say, talking about interest rates rising at the beginning of the year and indeed throughout the year, but also with the Russian invasion of Ukraine. So can you give us an idea of what changes you made to the portfolio to try to respond to events as they were unfolding and how you're positioned at the moment?
Yeah, most of the big changes we made were beginning in late 2021 into the first quarter of 22. And most of that related to reducing our exposure to the most highly valued part of the market, where these are great growth companies. However, they're investing heavily in future growth, so profit margins and free cash flow generation is depressed. And we didn't think there was going to be a lot of valuation support for that in a rapidly rising rate environment. So that regime change triggered us to take down exposure in that part of the market. At the same time, we started to increase exposure to higher free cash flow generators, still good growth companies, not as fast, but still really good quality growth companies, and kind of ride through the storm with that. Importantly, though, we never let go of the base consumer part of our portfolio, despite the war, the invasion of Ukraine, despite rising interest rates, rising energy prices. We felt like the consumer companies we own, which tend to serve very unique parts of the market, whether e-commerce in emerging markets or luxury out of Europe, that demand trends were going to be pretty rock solid, sustainable, given the type of markets they operate in. And that's proven to be true. And as we come into 2023, the consumer portfolio continues to lead the way, which we're pleased with. And we're hoping the technology part of the portfolio starts to improve as the year goes on, as concerns about demand pull forward, ease, and we start new product cycles in important parts of the market.
One of the things that the invasion of Ukraine has brought front and center is a focus on ESG, on issues surrounding the environmental, social, and governance issues. And that's certainly been something that's been key to investors over recent years. I think many people assume that growth companies in general are naturally more sustainable. Do you agree with this assumption? And can you explain how you factor in an assessment of ESG issues into stock selection and indeed monitoring your portfolio over time?
Sure. We would absolutely agree that growth companies in general have an easier time of it when it comes to ESG. For example, in your portfolio that we manage for you, the carbon intensity is extremely low because we're dealing with asset-like companies who are intellectual property based. They're not big capital-intensive legacy companies that tend to have issues that are tied to old industries. So from that perspective, it makes our life easier from an ESG risk assessment. Secondly, our companies tend to want to solve problems for people, right? That's what makes them growth companies. They're innovation-based, they're technology application-based. And so if it's consumer, it's typically solving for unmet need in the marketplace, solving for convenience, doing a better job with customer engagement. So again, we find a compelling backdrop for environmental and social issues. And lastly, the most important part of ESG tends to be governance. And that's going to be the one that really rocks stock performance the most. And so that's always been a key risk factor for us, something we monitor very carefully. If we see risks rising on that front, we generally are reducing our exposure. And if we get clarity on certain issues, we'll start to re-engage with a bigger position. But we're very careful with governance in particular because we think it's the one that can do the most harm to shareholder returns.
Yeah, and quite often some of the companies that you're invested in are at a slightly earlier stage in their development. And so engaging with management and really helping to teach management how good corporate governance works in this environment is clearly one of your key roles as a manager.
That's right.
After what's been a couple of bruising years for growth investing in general, what makes you optimistic about the future for your strategy? Maybe you could give us a couple of examples of stocks that you're looking at and what excites you about.
Yeah, we never see the level of innovation intensity easing, right? It's a very competitive global world, and innovation just seems to be pressing forward at an ever accelerating pace. And so we're trying to take advantage of that, right? We're trying to identify those unique early trends that could lead to significant investment opportunity for shareholders. And so A couple of the areas of the market today that I think are the most compelling, or one is more early development. That would be artificial intelligence. We've been talking about that a long time, and companies use it today to run their entire businesses. Like, Google is the biggest AI engine on earth, right? Paid search. But the development of these chat boxes or chat GBT out of OpenAI has really awakened the technology industry, because all of a sudden you can now use this generative artificial intelligence, so it just creates its own content as it improves, to do state-of-the-art applications for consumer service and engagement, for marketing programs, for R&D budgeting, for a whole host of activities at the enterprise level where the applications should drive a lot of software development going forward. Secondly, on the consumer side, you're going to see an increasing focus on developing the ultimate personal assistant, which will enable you through text commands or voice commands to accomplish real-world tasks very quickly. And so this is going to be the most exciting development that's come along in a while. This will be, sort of the next, we think, big platform of growth. And the only way we see to play it today that's hard and fast is the infrastructure side, because it requires enormous compute power. So data center investing, we think, is going to remain robust for years to come. The number one winner from that, we think, is NVIDIA, the semiconductor company that makes GPUs, which are used for both artificial intelligence training and at a hyperscale on inferencing. So we think they're in prime position to benefit from this big trend. And the stock came under a lot of pressure last year because of a slowdown in technology spending. But we think 2023, 2024 should begin a renewed period of growth for them. The second area that we think is tectonic in terms of its structural shift in an industry is in mobility. And that's the move to both electrification of vehicles and autonomous driving or semi-autonomous driving. And you want to play the leaders in that structural shift because they're really going to continue to drive better revenue opportunity than companies that are having to fight back or readjust their businesses from combustion engine to electric. So we would highlight names like Tesla or Mobileye in the autonomous driving area as potential winners or leaders in this area. Tesla, as you know, is very active in autonomous driving, but they have the compute power and the software to tackle that. Most auto manufacturers don't have that expertise. So we think they're going to outsource that expertise to other third-party companies who will bring a standard platform to them. And Mobileye, to us, appears like the big winner in that battle for the future of autonomous driving.
Well, thank you for that. I know you're also in Ferrari, Mark, and yes, you could argue that they're well underway to adopting electrification in the vehicles. Perhaps not autonomous driving, though. I can't see Ferrari customers wanting to be driven around.
No way.
Thank you very much for spending time talking to us today. I certainly hope that your optimism is well founded, and good luck for the rest of the year, and then obviously the years beyond that. Thanks very much.
Thank you, James, and thank you everyone for listening.
Thank you.